Welcome to the Certified Risk Management Pre-CRM Class Preparation video. Now, to adequately prepare for the CRM course, I highly recommend that you do 3 different steps. Step 1 is watch this intro video in its entirety, hopefully. This video will go through things like the basics of risk and uncertainty. We'll take a look at some cartoons to get started. And we'll talk a little bit about very high level on why risk analytics and real options are important in making decisions. And very briefly cover the IRM, or Integrated Risk Management Approach Methodology. The IRM is what we'll be focusing on in class for the next couple of days in a lot more detail. So we'll also give you a quick overview of advanced risk analytics, real options, reviewing some risk statistics, some real option stories and so forth, and provide you a high-level overview of the tools and techniques that you will be learning in this case. So what you need to do in step 1 is just sit back, watch, and watch it again if you have time. You can watch the integrated video, which covers everything, or the individual segmented videos, so you can jump directly to a specific segment if you're interested. In step 2, I would highly recommend that you review the intro readings. Those are chapters 1 and 2 of Modeling Risk and chapter 1 of Real Options Analysis, both second edition by me. And that would provide you a quick, overview of what, where, who, and how, and why, and get you really up to speed in terms of, hitting the ground running on day 1, the first minute when we're in class doing the Certified Risk Management. Now, step 3, this is for the overachievers among us. This is highly optional, but nonetheless very valuable if you want to get ahead of class, if you will. Or if you feel like your Excel skills or your modeling skills, using a computer and Microsoft Excel is not as facile as some of your colleagues, I highly recommend that you complete the basic exercises. We will be doing these exercises in more detail in class anyway, so these are optional, but it will provide you a head start if you go ahead and try it out, if you will. So the basic exercises are in your handouts in the booklet that you have as preparatory, and it goes through step-by-step examples, and you can follow along very easily. You will have to install the software first before you can go ahead and do the analysis. By way of introduction, I will be your instructor for the CRM. I'm Dr. Jonathan Munn. I've authored 12 books. The software applications, I've actually written them. I've created those. The Real Options SLS, for example, is the only software out there in the world that does real options analytics. And we'll go through, in a little bit more detail on using tools and applications. Now, just to stop you right here, you got to be very careful because the CRM is not about learning how to use the software. This is not a software class. It will probably take about 1 hour to teach you how to use the software, and that's it. We're more interested in learning how to actually apply it in real life. So we will be going through a lot of business cases, applications, hands-on applications. You will be sitting in front of a computer and you will be clicking away. So by the time you're done with the course, you will, in theory, be able to, hit the road running, so to speak, and do the modeling and so forth very easily, and with the tools as well. Now, that's one point. The second point is we're doing risk analytics. We're running hundreds of thousands, if not millions, of simulations. These are things that you cannot and should not, and it's impossible for you to do manually. You just can't do it. Even with a computer using Excel, you can't do it because we're running millions of trials. So in this case, we would recommend, you don't have a choice but to use software tools and applications. And the tools and applications come with, the course and so forth anyway as a package. So you have access to, the tools, the applications, and the books, and of course, all the details and so forth. Now, let's just sit back and watch a couple of small little cartoons here, and let's talk through risk and uncertainty, if you will, before jumping in and doing anything, heavy duty. So we have 2 pictures here. The picture on the left with the guy smiling, and a picture on the right with a roulette wheel. And we have 2 words, separated by a conjunction. So we have risk and uncertainty. Question is which is risk and which is uncertainty, right? Picture on the left is risk. Picture on the right is uncertainty. Now, very interestingly, just because there is uncertainty does not mean you have risk. But if you have risk, by definition, you will have uncertainty. You have uncertainty. So in other words, if you're just sitting, and watching the roulette wheel spin and you don't put any money in, you have uncertainty. You don't know what's going to happen. Is it going to be a red 30, a black 11, and so forth? The moment where you put money in and you put a bet, because you put an investment and so forth, right? You acquire a company and so forth, then you have risk. So you will not have risk unless there's uncertainty. If you know 30 is going to come up, well, put all your money on 30 already, right? So risk by definition, has uncertainty. Uncertainty, by definition, may or may not have risk. So whenever we talk about risk analysis, we're actually talking about uncertainty analysis, if you will. So different types of risk: political risk, development, natural, corporate risk, operational risk, technical risk, environmental risk, all different types of risk. You may have market risk. This is price of oil over a couple of years. So things can actually, fluctuate significantly. That's risky. That's uncertainty. Terrorism risk on the high seas in Southeast Asia. So these are a number of piracy attacks or pirate attacks and so forth. So a lot of uncertainties. Why do we care about risk? Well, because things can go really, really wrong in these pictures, as you can see. Or things can go really, really well, so better than expected, like in this oil and gas example. So it could go zig, it can go zag. Things can go up, things can go down. The question is, can we look into this magic ball and try to predict the future? You can try, of course. So unfortunately, predictions can sometimes be wrong, oftentimes be wrong. The economists actually did an experiment years ago where they got about 100 economists in a room and said, forecast all prices for me for the next 15, 18, 24 months. And of course, they did a lot of analysis. These are some of the smartest people in the world. And of course, what's the headline in this case? We were wrong. we got it completely wrong. And these are some of the best people, that in their industry. Now, can experience help? Of course, senior management, been there for 30 years. I know what's going on. Of course, experience, gut feel definitely helps, but not always. Here's Captain Smith of the Titanic. Says that this is the best ship there is. It ain't gonna sink, but guess what? A lot of people died on that ship. So dealing in the real world, this is a direct quote from a NASA scientist on Project Columbia, if you remember, that actually blew up. So if you really want to, deal with real life risks in real world environments, you cannot reduce all risks. You cannot quantify all those risks. What you can actually do is figure out how much risk you're willing to tolerate. So you need to be able to at least quantify it and be able to say, how do I mitigate that risk? And is that risk sufficient enough? What are my alternatives? So the real options piece. What are my alternatives to mitigate that risk or take advantage of the upside? Because risk could be both upside and downside. So how do I leverage the upside and reduce the downside? Now, traditional analysis, traditional risk, methodologies, they would use something like a risk matrix. So on the y-axis, you have impact, high, medium, low. Impact in terms of dollars or strategic impact. And then likelihood would be like probability, high, medium, low. So if it's high and high, high impact, high likelihood, it would be red. And then you have yellow in the middle region and then green, for example. Now, if you happen to be an executive or a decision maker in a multi-billion-dollar company, you don't have just one project or two projects. You have hundreds of projects, if not even more. So now you have 20 projects that are red, 5 that are purple, 7 are magenta. I don't even know what magenta is. 8 that are green and 72 that are purple. How's your company doing? What should you be doing? How's your portfolio doing? So qualitative risk, absolutely important, but insufficient. It's not even close to be good enough. It is important nonetheless, but not good enough. So if you can send somebody to Mars and back safely in a spacecraft, then the least we can do is actually be able to apply some types of analytics to it, right? Quantitative analytics, if you will. So don't do what this cartoon is telling you. So here's the Chief Risk Management Officer, the CRO of a company. And after, thorough review, the answer is be careful. Okay. All you can tell me is be careful, right? So that's very, very dangerous. Don't do that. So here's a very simple calculation to show you why risk might be important. If I have 3 projects, let's simplify and let's say we have X, Y, and Z. Okay, 3 alternatives. So each of these have different costs, 50 million, 250 million, 100 million. The returns net of cost, so the net present value is 50 positive, which is good, 200 and 100, and a different risk, potentially losing 25, potentially losing, risking 200, and so forth. So if you have a budget constrained manager, a cost and budget, I just don't have enough money, in my portfolio, I'll probably choose project X because, hey, NPV is positive, it's good, let's do it. If you're returns driven, non-resource constrained, you have all the money in the world, you have enough money, if you will, you're the decision maker, the manager, and you're trying to, increase returns, increase profits, and so forth, you would jump in with project Y. Now, if you happen to be very close to retirement and you're risk-averse manager, then chances are you will go with project Z with the lowest risk because there's still returns, there's still some costs, intermediate. So you have 3 types of managers, 3 different projects, 3 different decisions. Now imagine, if you will, add 20, 50, 100, 200 more projects into the mix, you got a problem. Okay, which ones do you choose and why? Now, if you happen to be a smart manager, you would choose project Z in this case. So the question is why? Now, the same numbers that we see previously are listed up here again for your easy reference. So let's just assume that these things are replicable, extendable. You can replicate multiple projects. Let's just say your budget is $1,000 or $1 billion. Now, I can buy 20 project X's because each project X costs $50 million. So with or $50 with $1,000, you can buy 20 projects, and you can purchase 4 project Y's and 10 project Z's. That's what we're doing here. Okay, and then you just multiply the total returns. Let's just say it's very basic cumulative. Now, for each dollar of return, you are getting 50 cents of risk for project X. Each dollar return, you're getting $1 risk for project Y, and Z, you're getting $1 return and 10 cents of risk. So for the same amount of return, the lowest risk in this case happens to be project Z. Okay, you take the inverse of this. For each dollar of risk, you're getting $2 return. Each dollar risk, $1 return. Each dollar risk, $10 return. So for the same amount of risk, you're getting the highest return in project Z in this case. So whether it's bang for the buck or buck for the bang, if you will, project Z is the right approach if you think about risk in this case. So what we're looking at is if you were to draw a chart or chart this out, the y-axis will be return, the x-axis will be risk. So if you're comparing A and B, for the same amount of risk, the highest return will be project A or portfolio A. If you look at A and C, the same amount of return, the lowest amount of risk would be A. Compare D with C, D would be the most efficient. So any projects or combinations of projects, which means these are portfolios, would be on the efficient frontier, investment efficient frontier. So think of A in this case as either an individual project, or in companies we would have a portfolio. So portfolio A comprises project 1, project 25, project 36, and project 8. And portfolio D will be project 5, project 6, and so forth. Subject to different constraints, budget constraints, time constraints, schedule constraints, risk constraints, and so forth and so on. Strategic constraints, okay? There is an investment efficient frontier. That's the best combinations and permutations of projects that you select that will give you the highest bang for the buck in this case. So in class, we'll take a look at, in the CRM, Certified Risk Management class, we'll take a look at correlations, diversification, efficient allocation, different combinations, and so forth, and project selection. How do we choose the best projects in your portfolio and so forth? Now, the approach that we will be using would be this thing called Integrated Risk Management, or IRM approach, the methodology for our CRM course. So it's an 8-step process. On the y-axis of each of these, you see the word risk. That's the main keyword, if you will. So risk identification, risk prediction, risk modeling, and so forth. So step 1 is where you list your projects and strategies that you want to evaluate. So senior managers will come in and say, "Oh, look at these 5 things that that you should be evaluating for me." Pitch it to the board of directors or whatever. So you start with 5, 10, 20, of these projects, or be a proponent of a project or an investment, application. Now, step 2 is where you come up with base case projections. So prediction, if you will. You're predicting the future. You're not using historical data per se. You're using historical data, you're using experience, you're using forecasting techniques to project the future, because investments are for the future in this case, and future is important. And so we can use in class, we'll use Risk Simulator. We'll run a lot of time series forecasting methods, decomposition, ARIMA models, GARCH model, all that good stuff, regression analysis, and so forth to forecast. So what will all prices be? What will revenues be? What's the operating expenses, going forward and all that? We will typically will also do things like scenario analysis in this case, sweet spot analysis. So at what point, under what tax rates, under what growth rates, under what assumptions is this project NPV going to be positive, and so forth. Okay, so scenario analysis, sensitivity analysis, tornado analysis, we will do spider charts, we'll do a lot of those. Identify your critical success factors, your CSF, what kills your project, what makes it successful, and so forth. Then in step 3 is where we put it into a model. Whether it's your economic model, financial model, it doesn't matter. It's probably going to be a static model at this point. And this is where traditional analysis stops, step 3. So you have an NPV value, net present value, using your discounted cash flows. You may have an internal rate of return, payback period, and so forth, right? The basic metrics, profitability index, okay? That's where traditional analysis stops. It just says that 1 + 1 = 2, and that's the answer. But in reality, we don't know if it's going to be a million plus a million. It could be 1.2 million, it could be 25 million. There's risk, there's uncertainty. So step 4 is where we step in and do more analysis, where we apply quantitative risk analytics. And the approach that we use will be risk or dynamic Monte Carlo simulation or risk simulation. We're simulating risk. We're running simulations of all possible outcomes, thousands, tens of thousands, even hundreds of thousands or millions of trials, okay, to look at all possible contingencies, what potentially could happen, will happen, has occurred in the model, and we still capture what is my risk quantitatively, and how does this affect my NPV? How does it compare across multiple investment projects within the portfolio and so forth? That's what step 4 is all about. We'll be doing that a lot hands-on in class. Now, step 4 is the quantification of risk. And if we stop at step 4, we should call this integrated risk analysis because we're just doing risk analysis. But in reality, we call this integrated risk management. And management just means you cannot manage something you cannot quantify. You must first be able to quantify something. So integrated risk management means don't stop there. Okay, you got to be able to quantify. Now that you've quantified your risk, the question that you should be asking is, so what? You know, we know there's a 5% chance this will happen. There's a 25% chance that will occur. So what? Okay, what are you going to do about it? That's what step 5 and step 6 comes in. Steps 5 and 6 are your real options. 5 is framing those options. This is analysis of alternatives, AOA, or COA, courses of action, depending on what you want to call it, or real options analysis. That's the technical term, again, real options. Having options or managerial flexibility is another terminology you can use. You have flexibility. If you have flexibility, then if the uncertainty is unknown at this point, and you have the flexibility to make a left, make a right, make a U-turn, okay, how much is that actually worth to you? So find risk mitigation techniques, alternatives and pathways and so forth. That's framing the options. That's more of thinking, strategizing, coming up with it, drawing the pictures, if you will. Strategy trees, decision trees. But we will be spending a lot of time on strategy trees or option trees. And in step 6 is where we actually do the number crunching, run the simulations, get the volatility, the risk, the quantification, look at individual pathways, individual options, and figure out the value of those options. Okay, so you can make a decision. So drawing trees are great, are wonderful, but if you can actually get numbers, it's even more powerful to make better decisions. You know, risk hedging in this case, so risk mitigation, reduction of risk. Now that's for an individual project, investment, so forth. In step 7 is where you put those individual investments into a portfolio. Companies don't just have 1 or 2 investments. They have multiple, corporate investments, multiple large corporate investments. Some of these corporate investments affect each other. They could be mutually exclusive investments. Some of these are nested investment. You cannot do, project Y before you do project X. Okay, X and Z are mutually exclusive. You pick one, not the other, and so forth and so on. There are correlations, effects, and so forth. And just like buying stocks, for example, if you own a stock, make sure you own a stock portfolio, because when you have a portfolio, what happens is risk is mitigated. Okay, it's risk reduction. You're reducing your risk. So never buy individual stocks in this case, right? So when you combine multiple stocks or multiple assets or multiple investments, corporate investments, what happens is within a portfolio environment is your total portfolio risk for the company actually decreases. So you want to figure out what is the effect on the portfolio. Okay. So, and also, if you have a portfolio, say, of a budget constraint, $1 billion, $100 million, whatever. So, what projects, do you choose? What investments do you choose? So, if you have a budget constraint, budgetary constraint, time constraint, resource constraint, human resource, strategic requirements, all these different things, out of 50, out of 100 different opportunities, which ones do you choose? Which is the top 5, the top 10, top 20? Subject to your budget constraints, subject to your all these other requirements, subject to the risk, the uncertainty, subject to all the real options and the pathways and the alternatives and so forth. So we link everything together into a portfolio optimizer, and we do something called risk diversification. And then comes step 8. Step 8 is the fun part, where we create charts and we present the results to managers, right, to the bosses, to say, well, this is what we believe is the case, having gone through this due diligence exercise, having gone through all the modelings and all the analytics and the simulations and so forth. This is what we believe ought to be the recommendation. Now, step 8 also, the last sentence is step 8. The last line says, do it again iteratively over time. So what that means is 1 to 8 is not a one-shot deal. You don't just do 1 to 8 and be done with it. Projects usually go for multiple years, 5, 10, 20, 30 years sometimes. And so 6 months later, a year, 2 years later, when uncertainty, when risk becomes resolved, becomes known over the passage of time, action, events, stuff happen, you need to come back and redo the analysis again with updated values. So do it iteratively over time so that you can actually make mid-course corrections, execute on that strategic flexibility when it becomes optimal to do so. That's what step 8 is all about. And you need to reiterate, go through the whole process again, if you will. So now we will hop on to a next module called an overview of risk simulator, and we'll take a look at some hands-on modeling techniques. This is the part where, again, you sit back, relax, watch, and just, see on a very high level. We'll do a 30,000-foot view of what, where, who, and how, and why of real risk simulator, doing risk simulation and Monte Carlos, and some of the techniques that we will be doing in a lot more detail in class in the CRM, the Certified Risk Management course. And after that, we'll revert to the real options theory. We'll talk a little bit more about real options, what, where, who, and how, and why. What is it? Very high level, some stories. And then we'll take a look at the real options tools, techniques, how we would go about, running some of the analytics. And we'll try to wrap up the preparatory video at that point. So see you in the next module.
This is a sample model showing how Monte Carlo simulation is run. Your model can be as simple or as complicated as you want, and Risk Simulator will run it inside Excel, or you can use our other software tools to run simulations outside of Excel, such as using ROV Risk Modeler, ROV Risk Extractor, and so forth. All that is required is as simple as 1, 2, 3. Set a profile, set inputs and outputs, and run. Let's take a look at how simple it is to set up a model to run. And by the way, assuming you installed the software, when you start Excel, you will see Risk Simulator starting as well. There are multiple sets of icons you can rotate among or access all the functionalities through Risk Simulator's main menu. Help files, user manuals, and multiple example models are available from the menus and icons, as there are over 1,000 functions and models in the ROV Modeling Top Toolkit software, which works together with Risk Simulator, and our in-class hands-on trainings, training DVDs, and 10 published books authored by Dr. Jonathan Munn on these topics. To illustrate how simple it is to set up and run a simulation, take for instance this simple example, where we have the world's simplest model. On the left, we have a static situation where $2 minus $1 equals $1. In a perfect world without risk and perfect foresight, this model is perfect. However, in a world fraught with uncertainty and risk, we're not sure if we will get exactly $2 million in revenue, or cost exactly $1 million, and so forth. So, we can run a simulation on this model, which again is as simple as 1, 2, 3. First, we set up a profile. A profile provides a place to store all the inputs and outputs we are about to set up. Then, we select the input revenue, and let's say this value $2 million happens to be uncertain. We can set this as an input assumption in a simulation by clicking on Set Input Assumption, either on the icon toolbar or in the menu. Here, there are over 25 distributions you can choose from, but to get started, we will use the triangular distribution, where we have a worst case, most likely, and best case scenario, and we enter in some values. We can do the same thing for cost as an input by setting it up as a uniform distribution, or an equally likely probability of anywhere between the minimum and maximum values. Then, we set the output or result cell as the output forecast. Now we're done. Profiles, inputs, and outputs. Now let's run the simulation. Notice that while the simulation is running, everything in the model comes alive and starts moving. In essence, you are running thousands of scenarios and scenario analyses simultaneously in a coherent and structured statistical and mathematical way. And by the way, in case you are impatient, we even have a super speed simulation tool that will run the analyses at 10 to about 1,000 times faster on average. Finally, we will see next how to briefly use the resulting forecast charts. The results from a simulation are forecast charts that we will spend a lot of time on in follow-up videos and live training courses, where we will decipher them in more detail. Briefly, you can view the resulting risk statistics, change the preferences of the look and feel of the charts, and perform confidence and probability analysis. For instance, you can select two-tail and enter in a % value and hit Tab on the keyboard to get the two-tail confidence interval, which means that in this case, 90% of the time, your net income will be between $0.814 million and $1.137 million. That is, there's a 5% chance it will be below this value, 0.814, or 5% chance it will be above this $1.137 million. Alternatively, you can select one tail and enter in a value and hit tab to get the probability percentile instead. For instance, there is a 61% chance that your project will yield less than the projected $1 million. So you think you're getting $1 million, but there's a 61% chance you will not even hit your projected $1 million. Now imagine if you have multiple projects and if all of them have similar financial situations like 2 minus 1 in this case, it will be fairly difficult to decide which project to invest in. However, with simulations, you can get the probabilities of events occurring and hence the risk. Now you can add an extra element of information and knowledge to your decision-making process. Therefore, you can now choose the project with the highest probability of success and so forth, or be able to identify your value at risk or what the chances are that you might lose your shirt and so forth, as well as obtaining a lot of risk statistics that you can compare one project against another. The next question you will probably ask is, what distributions do I use for the model and how do I choose? Is it a normal, a triangular, uniform, beta, gamma, Weibull, and so forth? Well, you have books to go into the theoretical underpinnings of each of these distributions and when to use them. Specifically, look at Dr. Jonathan Munn's Modeling Risk textbook. Or if you have data, such as this example, simply select the data and run a distributional fitting tool in Risk Simulator. This will test all the theoretical distributions and tell you which has the best fit and how good the fit is. Therefore, this tool takes all the guesswork out of your simulation modeling. You are then probably asking yourself which inputs would you set as assumptions. Risk Simulator's tornado analysis will take care of identifying the critical success factors and key drivers in your model by identifying which inputs are most critical and have the highest impact on the outcome of your model. The result is a nice detailed report with scenario tables and tornado charts that identify which of your inputs are critical in the analysis. Now you can spend more time getting better input data and assumptions on these key variables rather than spending time on the wrong inputs. Risk Simulator also has over 15 basic and advanced forecasting tools that are super simple to use and can be run within a few mouse clicks away. Here is a list of the advanced forecasting techniques such as ARIMA, Auto Econometrics, Basic Econometrics, Cubic Spline, GARCH, markup chains, multiple regression, time series decomposition, trend lines, and much more. Here is an example of some historical data. Let's see how simple it is to run a time series forecast. Simply select the data, select the time series forecasting tool, enter in how many periods you wish to forecast, and you're done. It takes a few seconds, and the results are shown in a detailed report, complete with the forecast results set up as assumptions, which means the forecasts are no longer single-point estimates but dynamic in nature. You are also provided the accuracy and error measurements of the forecast, and a nice forecast chart is provided. Notice that in this chart, the analysis performs a backcast or fitting into historical data before performing a forecast of future predictions. Notice that the forecast picks up the upward trend and seasonality swings automatically from your forecast or historical data. By running through advanced algorithms and techniques, it does a backfitting of historical data before it does a forecast fit. We have many more advanced forecasting tools, all of which are just as simple to run and yield detailed reports, tables, and charts as you see here. Next, if you have a lot of very different and risky projects or investments to choose from, but at the same time you have a very limited budget or limited resources such as full-time employees, budget constraints, and so forth, which ones do you choose to create the best portfolio of investments? The answer is you can use Risk Simulator to run portfolio optimization to find the best combination of projects and investments subject to budget and resource constraints, as we're seeing here. You can also use portfolio optimization for investment portfolio allocations to find a portfolio with the highest return to the least amount of risk, subject to risk and uncertainties in the rates of return. In this example, we're running a stochastic optimization where simulations are first run to determine the risk and uncertainties of each asset class, and then an optimization is applied, and the process is repeated many times. To learn how to set up this model and to run an optimization, refer to some of the more detailed getting started videos that are free and available on our website. Do you have lots of data and do not know what to do with them? Well, there are multiple tools such as data diagnostics and statistical analysis in Risk Simulator. Let's see what these things do in less than 2 or 3 mouse clicks away. All you need to do is select the data, click on the tools that you wish, answer a few basic questions, and hit OK. And you can perform all the analysis you wish quickly and without any effort on your part. And the results come complete with detailed reports to get you started in the interpretation of the results.
Welcome to the Introduction to Real Options Analysis, a quick overview. The agenda starts off today by looking at a new paradigm of this thing called real options analysis, specifically looking at the what, where, who, when, how, and why of real options. In fact, half the challenge, or 50% of the challenge of real options analysis is just thinking about it, framing the problem, understanding the theory. Whereas another 25% of the value of real options comes from actually performing and doing the analysis, obtaining credible results, and so forth. And the remaining 25% of the challenge of real options is the ability to explain it to yourself, to senior management, to the board of directors, to your client, to the person sitting next to you. So we will then continue to understand a little bit more about the risk analysis process and spend some time on looking at several actual business cases, consulting projects that my company and I have personally consulted for, just to have an idea of how real options analysis can be used in industry. We'll then finish the presentation by looking at the real options SLS calculations, the tools and the software and so forth. So that's the idea. Now, there's a lot of buzz in the industry on real options. For instance, several Harvard Business Review articles back as far as 1998, and even as recent as 2011 and 2012, state that real options is the next best thing. In fact, Business Week calls it the next major business breakthrough. Industry Week calls it a much better approach for valuing flexibility. So the question is, what is this real options? Why is it superior? Is it better? How does it compare with traditional valuation methodologies like net present value, discounted cash flow, return on investment, internal rate of return, ROI, IRR, and all those different metrics? So examples of companies using it. What are some of the characteristics or circumstances as most amenable for real options? So how do you know that a project or an investment opportunity is applicable in terms of real options analytics? So we'll take a look at some of these things, and of course we'll go into the how, when we do our Certified Risk Management or CRM course. That's why we have a 5-day course to understand the integrated risk management, the whole entire analytical methodology. So this is a quick and dirty definition slide. Here's my textbook definition on integrated risk analysis. The key takeaway from this slide is that real options is not an equation or a set of equations. It's not A plus B equals C. So real options is, you don't get a magical result from real options analysis. Instead, real options is an analytical process. It's a methodology, a process, step by step, that combines the best practices of finance, economics, decision analytics, risk analytics, options, theory, statistics, business intelligence, all these things, and put them together in a nice little package for making decisions, for capital investment decisions, for valuation, for hedging risk, mitigating risk, and so forth. And it's applicable in all industries when you have uncertainty and risk. Okay? But as long as you have some flexibility or options or alternatives. This is one of my favorite slides, actually. So the question for this slide is, why do we care about real options analysis? The top left picture is analogous to a traditional analysis, like a discounted cash flow or net present value on investment or return on investment approach. It shows that going from point A to point B is a straight line. So if benefits outweigh the costs, so you have in net present value analysis, you have benefits, you have costs, you have revenues, you have costs. So if benefits outweigh costs, execute a project. So NPV is positive, or IRR is above the hurdle rate or the weighted average cost of capital. If it does not exceed the value or the hurdle, then don't do it. So this is clearly a very myopic view of things, very short-sighted, if you will. The bottom left picture is analogous to real options analysis. So it's a little bit more complicated, where in going from point A to point B, there are a lot of uncertainties. This picture reminds me of a seminar I gave a couple years ago in Tokyo, when I traveled from Narita Airport to downtown Tokyo and Shinjuku area. And there were many road signs with convoluted pathways and red and green lights, indicating traffic conditions and so forth. So if you have multiple strategic options, that is, in this case, the ability to make a left, make a right, make a U-turn, how much is a GPS or strategic roadmap or a walkie-talkie that you can call, your fellow, your friend who's like 2 miles ahead of you? So when the uncertainty becomes resolved over the passage of time, action, and events. So in other words, coming from downtown, from the airport to downtown Tokyo, I have no idea what the traffic conditions would be. There are 5 ways to get there, 10 ways to get there. I take the best straight approach that I can at this point. However, based on the uncertainty that becomes known over time, there's traffic here, there's an accident, and so forth. If I know alternate pathways to get there, I can make a left, make a right, make a U-turn. And still get me to point B, thereby mitigating my risk, reducing the uncertainties, and so forth. How much is something like this worth to me? How much are the billboards with convoluted pathways up on the highway, on the side of the highway with red and green lines actually worth? Or how much how much is my GPS or my strategic roadmap actually worth? That's what real options does. So it allows multiple decision pathways and analysis of alternatives or courses of action, maximizes your flexibility financially for investments. It recognizes, managerial decision making. You're project managers, you're decision makers. You do not just make a single decision for the next 15 years. You continually update your decisions over time. And so there's like midpoint corrections, if you will, along the way. And therefore, you're able to incorporate new assumptions over time when things become known. So risk is variable, and therefore, when risk becomes resolved, it becomes known, you can make, take the alternate pathways and so forth. So here's an example slide of who uses real options analysis. I'm going to give you a quick couple of generic examples. In class, we will go into very industry-specific applications. So if we're doing oil and gas, for example, we'll do a lot of petrochemical examples, or company-specific examples and so forth. But for the purposes of an introduction here, we'll go through very high-level examples here. So let's spend a couple minutes here on sample business cases, and these are real cases, and how real options were used in the industry. These are based on actual projects and consulting works that I have personally done, although the numbers and the stories have been tweaked, of course, to protect the innocent, if you will. So let's just say, for example, Boeing takes 7 years and up to $7 billion to develop the next 787, dream jetliner. So imagine, if you would, what would happen if the wrong prototype were developed? Airbus would come in and just pulverize them. So Boeing faces 2 major sources of risk, and you can just lump them into 2 groups just to simplify. The first will be market risk. So that is the economic conditions, competitive landscapes, and so forth and so on years from now. And a second group of risk, which is private or R&D risk, a technical risk. So if the plane will actually take off, for instance. So Boeing uses an option to abandon, or abandonment option, and an option to switch, or switching option, to hedge the risk. So for example, they perform parallel development on, say, 5 simultaneous prototypes, 5 simultaneous engines, and so forth. So parallel development. So as uncertainty and risk becomes known over time, actions, events, they can abandon one of the prototypes if, the engine doesn't work, it blows up. You can pull the plug, if you will, abandon one prototype, reallocate the resources to the other 4, 3, 2, eventually 1, thereby mitigating the downside risk. So you have the option to abandon, option to switch in this case. Now Airbus in Toulouse, France, actually heard what I was doing with EADS, and that I was also doing some real options work with Boeing, and wanted to know how they can apply real options in this case. Now, Airbus was interested in hedging market risk in this case. So, for instance, Airbus sells its A340s or A320s in the primary market to airlines like Continental, United, SAS, and so forth, Emirates Airlines. So, pick a number, say 50 million euros. It doesn't matter what the amount is. Now, SAS takes a lot of risk, or Continental Airlines or United Airlines takes a lot of risk by purchasing the aircraft now, putting in a huge lump sum, possibly up to 30 or 40% as a deposit for delivery a few years in the future. You don't really know when you're going to get it anyways. Now, as the economic conditions are unknown in the future, so if something bad occurs, economic downturn and so forth, SAS or United Airlines may have to reshuffle, reallocate its portfolio of planes, or even sell some of its planes in the secondary market, the used, planes market, if you will, for smaller airlines like Air Asia, Thai Airlines, JetBlue, and so forth would purchase. The problem is the prices in the secondary market, are highly volatile, and the value of the plane is unknown. So Airbus can provide an option, in this case, an option to abandon, for United Airlines, where Airbus agrees to buy back the plane within, say, a 5-year time period and guarantee a residual buyback value of, say, 30 million euros. So what Airbus has done is provide a safety net, if you will, an insurance policy, if you will, where if the price of the plane will never fall below this 30 million euro or $30 million. So if the secondary market's price is, say, $35-40 million, it's still high, it's still valuable. What United Airlines can do is sell it in the market if you need to get rid of the plane. But if it falls below 30 million, so 20 million, 15 million, and so forth, you can cut your losses, mitigate your risk, mitigate the downside, pick up the phone, call up Airbus, and you've executed your option to abandon and get a minimum of $30 million. So the question is, how much is this safety net or option to abandon actually worth to United Airlines? So think of a normal distribution with its left tail as the risky side in this case. And I will jump a couple of slides real quick. It really doesn't matter what distribution we're looking at, but let's just say it's a normal symmetrical distribution. Now the left tail is going to be the risky side. So the wider the distribution, the higher the risk. So what we have done literally is we've taken a really sharp knife and chopped off the left tail at 30 million euros in this case. So anything to the left is of course risk, because you can sell your plane at a much lower price. So by truncating the left side, what happens is you've done a truncation, you have skewed the distribution, you've chopped off the left tail. And so the mean, the expected value shifts to the right. So value enhancement. And by chopping off the left tail, you've reduced the width or the risk. Therefore, you've reduced risk or risk mitigation, risk hedging. So risk hedging, risk reduction, value enhancement in this case. That's what this option to abandon is actually done for you in this very, very simple example. Now, oil and gas, a lot of applications of oil and gas, of course. Refineries, the sizes, different inputs, different outputs, different ways of doing it, different capacity, storage, so many applications. But let's just do a very simple one. Let's say BP, a small little company, right? BP, British Petroleum. Their deep sea drilling project, this is Project Atlantis, actually built about a decade and a half ago, almost 2 decades at this point, cost over $2.5 billion to run. Okay, to implement. Now, BP faces 2 major sources of risk again. Again, we're lumping into 2 different groups. The first would be market risk, and this is highly volatile oil prices and so forth. So prices are all fluctuating. And of course, private risk, which is the engineering risk. So things like size of the reservoir, pressure, porosity, cap size, and all the other unknown geological structures. All right, so the engineering issues. So you have private risk, the engineering issues, and you have market risk, the oil prices. So BP obtains the option to contract and the option to expand. So contraction option and expansion option to mitigate the downside and to capture or take advantage of the upside. Okay, so risk again and uncertainty could be up and down. So if it's upside, you want to have the ability, the option to take advantage of the upside. But if it's on the downside, you want to be able to mitigate your risk. So the option to expand is to develop a larger platform than required, which temporarily is sitting idle until the time when price of oil is so high or extremely high, and that the expansion option is executed and the additional facility is expanded. So you're building this Project Atlantis at size X by Y, square meters. But how much does it cost, if it costs you anything extra, to build a slightly larger platform, which you don't need at this point? But when the time comes, you have the option to execute, implement, and use the additional platform and drill for additional oil in this case, or make that ejector into an injector, inject oil, air, or inject water in there to increase the pressure size and therefore get a higher level production. So a lot of different ways to capture the upside in this case. Option to expand. Conversely, an option to contract could be created with a counterparty. So let's say a smaller, tier two oil and gas engineering company, where this firm will take over all operations, okay, and cost of running the rig. So BP can send all of his engineers home, reallocate resources to some other project somewhere else that's more profitable, and you save on your operating expenses. So your operational cost goes to zero. Okay. While in the meantime, the counterparty will get, say, 30% or 40%, whatever, of the revenues, and BP will keep the 50, 60, 70% of the revenues. That's based on negotiation, of course, without spending anything extra. This is great for BP because you can redeploy your resources elsewhere, cut costs, operating costs to zero, but still capture and still participate in part of the revenues. And without spending any additional funds because it's already sunk costs. You've already spent all that capital up front. While the counterparty, the smaller company, gets the use of a huge $2-3 billion rig without spending a single dime on development costs and still obtain some revenues. And these guys are supposed to be lean and mean, and therefore their operating expenses are lower anyways. So it's a win-win situation. Option to contract. Again, a lot of examples in oil and gas, which we can go into a lot more detail in class. Next, we have another example like Intel, Seagate. Let's just pick Seagate as a very simple example. Back in the late 1990s, this was a while back, they were in the process of developing a new hard drive that is super compact, very small, and and high capacity. So which means it's very difficult to create. And it would take them 4 to 5 years, and let's say, pick a number, let's say $40 million to do research and development to develop this. So $40 million, let's say 4 years to do R&D. So this is the same type of hard drives that we enjoy right now with 2.5-inch, 5700 RPM hard drives. High capacity, and small. So the higher the capacity, the more difficult it is to manufacture, engineering-wise. And the smaller it is, the more difficult it is because the hard drive has to spin faster and so forth. There are physics and engineering involved that is difficult to traverse at that point. So Seagate has at that point identified that this will take 4 years and $40 million and 4 phases to go through. So there's a phase 1, phase 2, phase 3, phase 4. Phase 1 might be developing the hard drive that can spin fast enough. Phase 2 that you can read and write quick enough. Phase 3 that it will retain in memory and so forth at a long enough period and so forth and so on before you can actually go to market in phase 4. So they're stage gate development process. So this is called a sequential compound option. So the option is compounded, it's stuck together in sequence. So sequential compound option. Now, alternatively, as an alternative analysis of alternatives, Seagate has identified a smaller startup company out there that already has, say, 50% or 75% of the technology that they need already completed and developed. So, but this small company, this small startup, is developing the technology for some other, application in a different industry, which can be adapted by Seagate, clearly. And the small startup company knows their value. And they are asking for $50 million to be acquired. They're willing to sell their company. They're not willing to license. They just want to be acquired. So as far as Seagate is concerned, in an NPV or net present value traditional analysis, it's probably better to develop it themselves because it's the same market, same product, at $40 million cost compared to $50 million to acquire the company. So build or buy. But in a real options world, acquiring the startup, buying the startup, is actually gives you a lot more additional options. So first, by taking out the startup, by buying the startup, you take the startup out of the market, which prevents Seagate's competitors like Western Digital and all the other guys from getting their hands on this technology. That's a good thing. Next, Seagate should not value the firm based on a straight line, discounted cash flow, net present value, analysis by itself, because the firm can either succeed or fail. Okay, that's it. So let's simplify this. Let's say if it fails, if the technology doesn't work, Seagate can still execute an option to abandonment option, and sell the company's assets, intellectual property, patents, and so forth, and not lose the entire $50 million purchase price. So you might be able to get some salvage value back of 5, 10, 20 million, whatever the value is. On the other hand, if the technology proves to be successful, Seagate can put in some extra funds into the company and create spin-off products. So, for instance, if you purchase the company, you leapfrog your competitors by 2 or 3 or 4 years ahead of the market. So you can put, additional funds in there. You can capitalize on the market, or you can potentially do spin-off products, option to expand into different markets, different geography. So for example, you can put an interface around the hard drive, just wrap it up with a plastic with some buttons, and now you have an MP3 player. Okay, stick it into a television set, and now you have a high density, personal video recorder that you can record all types of high definition videos. You can take the portable hard drive and stick it into a car. And by the way, all new cars now, year 2011, 2012, and later, actually have GPS system standard, right? And the GPS system, it's literally a hard drive with a computer chip. So we have high capacity memory, and a million other applications that's out there as well. So Seagate does not or should not view purchasing or acquiring this company using a straight line discounted cash flow net present value, but you should also look at downstream options that's available. So options in the future downstream that is available. Otherwise, you are underestimating the value of this investment. Okay, so in contrast, if the startup company, the small startup, does not look at options or real options that it can bring to Seagate, it is actually leaving money on the table, on the negotiation table, and is undervaluing its own company. So there's a lot of applications here. Pharmaceutical applications, Merck, Pfizer, and so forth. The industry has really good textbook applications of real options. All drugs that are developed have to go through, at least in the US and multiple countries around the world, a multi-stage process, a phase 1, phase 2, phase 3, before going to FDA or Food and Drug Administration approval. So at least in the US, these are called stage gate sequential compound options, sequential options, phases. You cannot go to phase 2 without first passing phase 1. So you cannot test on humans, biological tests, unless all your rats survive in phase 1. If your rats die, you're not testing on humans in phase 2, right? You can also have other types of applications, spin-off applications of the same drug. Whether or not to fast track the development of a product to jump from phase 1 to phase 3 and so forth and so on. Whether you do an intermediate phase 2 before you do a phase 3. There are a lot of applications that, again, in class we'll go through in more detail. Peaking plan is another example as well for electricity, utility, coal-fired, option to switch inputs using different types of inputs and generation of different outputs. Peaking plan, utility, prices of electricity, for example, are very highly volatile, especially during summertime, and with high capacity and high usage and so forth. So how much is it worth to a power company, a utility company, to build let's say, a secondary inefficient, less efficient peaking plant that is cheaper, sitting up on a hill somewhere, that you don't really use for maybe 300 days in a year, but for those 20, 30, 50 days or 5 days in a year, when electricity prices are extremely high, when it goes up 200-300%, they can send someone to climb up the hill, turn on the switch, and continue to generate additional electricity and capture the additional upside. How much is this option to execute, option to run, option to wait before you make a decision to turn it on? How much is this option to wait, option to execute worth to you? And how much should you be willing to spend to build this plan? Additional, examples would be storage capacity, capacitors, which are just huge batteries, if you will. So during downtimes, you can just generate enough electricity, store it, hopefully, and hopefully you don't get, it's highly efficient, hopefully. And when you have high levels of usage, what you can do is take that out from storage and therefore be able to capture the upside and so forth. So how much are all these things worth? I can go on, and we can probably spend the next 2 days just talking about business cases and so forth. But I do recommend, if you have time, to review some of the business cases in my book, the Real Options Analysis Second Edition, for a lot more detailed business cases on different industries and so forth. A lot of applications in the U.S. military, Department of Defense, venture capital, telecommunications, merger acquisition, investments in general, corporate investments, capital investments, and all that. So a lot of applications there. Now here is the integrated risk management slide again, one more time. Now what we're talking about at this point is step number 5 and step number 6 on the IRM process. So if you can see on 5 and 6, which I've highlighted here, is risk mitigation and risk hedging. So reducing your risk, identifying relevant projects and different pathways or alternatives, if you will, courses of action and analysis of alternatives, AOA and COA. Where step 5 is called framing the option. And framing the option is more of identifying what the alternatives are, framing it, putting it together. And again, this is worth half the battle. This is 50% of the value. So we look at, the different framing, the different alternatives and so forth. And in step 6 is where we actually do the evaluation. So using things like the real options SLS software, crunching the numbers, running simulations, linking it from steps 2, 3, and 4, and linking it to step number 8. And number 7. So what that means is we have a NPV, net present value analysis, discounted cash flow, run the Monte Carlo simulation. And by the way, to do real options analysis, you must have traditional analysis. So step 3 is required. So your net present value, your NPV, your IRR, internal rate of return, and so forth are required. You need to do that first before you can do real options, because the results from those traditional analysis becomes the input into your real options. So we are not saying, toss out what is tried and true. We're not saying, take whatever you've done in the past and forget it. What we're saying is take what you have, add to it, add more sophistication by adding things like simulation, forecasting, analytics, and then lay on top of it the uncertainty analysis, risk mitigation with real options, alternatives, and so forth. All right, so that is the IRM process, and that's what real options is part of, if you will. Now, when are real options not applicable in this case? Well, the answer is don't apply real options everywhere. Apply it only when it's appropriate, of course. There are 5 requirements in this case for applying real options. So there must be uncertainty, of course. A model must be, built or can be built, must exist. So you must have some type of NPV, DCF, and so forth. If you do not, what that means to me is, a decision has already been made, or you don't have enough data to even make any decision. So you must have a financial model. Uncertainty must exist, and the uncertainty must exist and must be resolvable over time, events, and actions. So I don't know if this product will be successful. I don't know if demand is going to be at how many kilowatts per hour. Well, guess what? Wait 3 months, wait 6 months, and you will know, because the market will tell you. So the uncertainty becomes known over time, action, and events. So you can make an action, you can build something, you can execute a strategy, and something actually becomes known. The uncertainty changes decision and actions. Now, if the uncertainty or the risk does not affect your actions or your alternatives, if it does not affect your decision, whether financially, strategically, and so forth, then you really don't care. If you're not invested in the Zambian, kwacha, whatever, foreign exchange market, then, whatever the kwacha with the US dollar, foreign exchange rate is irrelevant to you. So the uncertainty must affect your decisions specifically. Flexibility or options. Okay, managerial flexibility. That's what real options is all about. You have options to do something, not the obligation. You're not forced to do something. Okay, you have the flexibility. So managerial flexibility or strategic options or real options must exist in this case. If you don't have options, why on earth are you doing real options, right? If you don't have alternatives, stop doing analysis of alternatives. Okay, and finally, management, decision makers, the powers that be must be credible enough to execute the options optimally when it becomes optimal to do so. So if you have the option to abandon, pull the plug, do something, and management doesn't do anything, guess what? All the options in the world would be useless. So management must be credible enough to execute the options when it becomes optimal to do so. And in class, we'll go through a lot of the caveats and cost-benefit analysis and when the applications of real options fit. And just a couple of real quick little slides before we wrap up this section of the video. Here are a couple of graphical intuitions, if you will. This is a straight line discounted cash flow, net present value. Year 1, year 2, year 3, 500 million, 600 million, 700 million, and so forth. Some cash flow. Now, if there's zero uncertainty, zero volatility, you can draw a straight line. It could be a jagged line, but it's going to be linear in this case. It could be non-linear, but you're connecting dots in this case. That's the point. It's one line. Now, this is real life. You can have actual values that could be above or below what your DCF, your discounted cash flow, or your net present value analysis tells you. So it can be overvaluing, undervaluing, and so forth. So there's some volatility, some risk. The higher the volatility, the higher the fluctuation, of course. So simulation, Monte Carlo simulation, risk simulation, the analytics that we'll go into in more detail, of course, allows you to capture the uncertainties, allows you to quantify the volatility, which is required before you can do real options. Okay, but it doesn't really tell you what the value is. Real options tells you what you can do. So if your uncertainty, goes above, peaks, for example, price of oil, price of electricity, and so forth, your demand goes up, what can you do? Can you exercise this option to wait, option to execute, expansion options, all these things? When things are low, in this case, in the red region, you can have the option to abandon, option to contract, option to switch, barrier options, all these other, types of options. Stop your and exit, for example. So real options analysis tells you what you can do given those uncertainties, and is the outcome of your risk analysis, if you will, to mitigate your risk and take advantage of the upside, as we've seen in this slide previously. So global acceptances, a lot of universities around the world teaching this. They're using my books, thank God. And different, locations around the world, different corporations are using these types of applications, of course. So a very, very powerful set of methodologies, which we'll go into in a lot more detail in class, in live, assignments and hands-on applications. So we'll continue. We'll see you in the next module, and we'll talk a little bit more about, using real options analysis, using the software tools, and so forth.
Assuming you have installed the software, click on Start, Programs, Real Options Valuation, and here you can access all of our software. Click on Real Options SLS, and you can see that various tools are available, starting with the main SLS software, as well as functions and an Excel solution tool, which we will be playing with later. For now, start the SLS software. On the main user interface, you can mouse over certain elements and obtain a description of the item. Here you can model single asset and single phase options such as abandonment, contraction, expansion, waiting, deferring, chooser, barrier, employee stock options, and many others. In the single asset SLS, you can access the user manual, which we highly recommend you review, a predefined set of variable lists, save, open, or print a file, or access our list of examples. For instance, we will open a simple plain vanilla call option. Notice that you can enter in the appropriate option values and hit Run to compute closed-form benchmark models such as the Black-Scholes or American approximation models, as well as binomial lattice results. You can choose American, European, Bermudian, or custom options. In fact, the power of SLS comes in when we run custom options. As an example, we can see an example called Expand, Contract, and Abandonment Customized Option. Notice that when you select the Custom checkbox, you can now access the various equation boxes where you can make your own model or make your own options, as well as create your own custom variables. Here's another example of a customized employee stock option that is solved using the custom option selection. The idea is that if you can conceive it, SLS can solve it. This allows you the complete flexibility in modeling and computing any types of real-life options. You can now use some of these example profiles to get you started, and then save this model when completed, or select Create Audit Sheet, and it will create an Excel file with a created binomial lattice for you as well. And please note that there are over 30 worked out sample short case studies, hands-on applications with inputs, and step-by-step modeling examples in the user manual, and we definitely highly recommend you review before using this tool. This short video is meant only as an introduction to the tool and does not go into the details of setting up and solving the options. Next, there is a tool for valuing multiple assets and multiple phased options, such as sequential compound, stage gate, phased options, or simultaneous options with switching capabilities, or multiple underlying asset options with any combinations of abandonment, switching, waiting, deferring, expansion, contraction, and others. In the multiple asset SLS, you can model multiple underlying assets in multiple phases. Again, you can use some of the pre-existing sample models to get you started, or review the user manual for more hands-on, step-by-step guidance. In the multinomial lattice SLS, you can solve mean reverting, jump diffusion, and rainbow options using trinomial, quadrinomial, and pentanomial lattices. Again, the same principles apply, and you can customize all your options as required. We then have the lattice maker, where you can generate binomial lattices inside Excel, so that the model can be run in a simulation, forecasting, or optimization model using Risk Simulator, another software we developed that complements this SLS. For example, let's enter in some sample inputs, and when it's done, we click Compute. Notice that when the lattice is created in Excel, the inputs are all visible, as are all the computations and equations. From here, if you wish, you can use Risk Simulator to set input assumptions and output forecasts, and run a simulation on model using Risk Simulator. Finally, there is an exotic financial options valuator with over 350 closed form, simulation, variance reduction, and lattice valuation models on options and options-related vehicles, including volatility computations, bond options, and so forth. You can change the language of the interface if you wish, and you can click on the Load Sample Values to load some example getting started values. Then select the model category you wish to run and select the models that are available. When you select the model of interest, enter in the required inputs and click Compute to obtain the results. Also, SLS comes in 4 languages: English, Chinese, Japanese, and Spanish, with more languages forthcoming. You can change the languages here, and you can see the language characters if you have installed the Windows Far East language pack that comes free with Windows XP and Windows Vista. At the bottom of the screen is where you can install the licenses. SLS comes with a default 10-day license, but when you purchase a copy of the software, you will have to click on each of these license tools to provide us the hardware ID and hardware fingerprint so that we can issue you your licenses. For instance, click on the first license to obtain the hardware ID, and the second licensing tool after that to get your hardware fingerprint. Once we receive your purchase order and these 2 IDs, we will be sending you the license files and license codes to activate your software permanently, as well as the instructions to do so. You can also access the Excel SLS Solutions or Excel SLS Functions tools via the Start, Programs, Real Options Valuation shortcut menu. The SLS Solutions file replicates the single asset and multiple asset SLS tools we just ran. But this time the analysis is based completely within Excel. Therefore, using this SLS Solutions file, you can link to and from other Excel files, worksheets, databases, and run simulations if required. The SLS Functions is also based in Excel, whereby once you start the functions, SLS will load them into memory for use, and you can access these functions directly inside your existing Excel models by clicking on Insert Function, choose the All category, and scrolling down to the SLS functions. You can now use these functions as usual by entering values or linking them to various cells in the worksheet.
This is ROV Visual Modeler version 2012, and currently we're looking at the Decision Tree module. Now when you start the Decision Tree or DT module, what you would see is a blank canvas where you can start creating your own decision tree. So let's just get started and see what happens. For instance, if I were to select this beginning cell or node, I can insert a lot of different things. For instance, decisions, uncertainties, or terminal nodes. So for instance, if I insert 2 levels of uncertainty, that just means, situation or event, first event could occur or the second event could actually occur with some probability. Now I can click on the uncertainty and enter in any type of a decision variable. For example, let's say there's a subsequent decision based on the uncertainty output. Click on that and potentially put another, say, 2 or 3 uncertainty levels, and depending on the uncertainty events that occur, I can enter in terminal nodes. So terminal nodes tend to be, in most situations, triangles. Uncertainty or events that could potentially occur with some probabilities are typically a circle, and squares are your decisions that you're making. So I have 3 decisions in this case to decide which path I want to take, for instance. So this is just a very, very simple way of inserting or creating your decision tree. Now I can click on any of these nodes and drag them around if I wanted to. move them around to wherever it looks nice, for instance. So let me click on this and move that around, for instance, just to illustrate. However, if I click on one of these intermediate nodes, when I drag them, what happens is you see all subsequent nodes tend to move together, all right, because that's by default. Or you can right click on this node and you can say move nodes individually. What that means is I can click on this node now and move it individually. All right, but by default, if you right click on it, it should say move nodes together. And so again, I can move any of these nodes, and all subsequent nodes will be moved by moving this single node. So that's a really handy little thing that you can do. The other thing that you can do is I can click on this, right click, or I can just go up to the edit menu. I can copy a node or copy a tree. If I copy a node and paste it, I will only paste that node. If I copy a tree, everything that's subsequent to this node, the whole entire thing will be pasted wherever I decide to paste it at. So that's pretty basic copy and pasting, if you will. Now after you're done with this, you can change the different shapes and colors or different styles. By default, there are several different styles here that you can change to. For instance, we call this fuzzy links. Looks relatively decent. Three-dimensional pictures, hollow point, sprawling 3D. So you can create your own style, by the way, and this is just pure black and white. So let's just go back to the default elegant 3D in this case. So that's looks like a three-dimensional picture. I can go into any of these nodes, double click on it, and access my node property. So for instance, I was selecting this node, double clicked on it, I can rename that node. For instance, I can call this the up situation or up condition, whether the market is up or down, whatever it is, and put a value in, say $100 million in this case, right? And I can also put in a note. I can say, the economy is up in this case, all right? And I can insert the note in this case, either above the note, below the node, or to the right of the node. So let's just choose to the right of the node and see what happens. And you see economy is up in this case. That's my notes. Up is the name of that node, and the value is $100 million. So let me just double click on that, and you can see everything that is that I've just done here. Now sometimes you may or may not want to show certain things. For instance, if I do not want to show any notes, I can turn this off. If I don't want to show values or names, I can turn certain things off. If I click OK, you see that's gone. So let me double click on that again and bring it back, nodes. All right, very simple to maneuver. It's just a single user interface. I can change the color of those nodes if I wanted to, but typically we'll say leave everything alone the way it is at default. You may, in certain situations, change colors of specific nodes, so it's entirely up to you. We may also put in a branch event name. I'll skip this label inside shape, and I'll use that for a decision node in a minute. But a branch event name, so this is a branch, and we'll call this, let's say good economy. We'll just give it a short and sweet name. We'll call it good, and you can see this is good. And so I can double click on this branch, and I can call this bad if I wanted to, and therefore this is the bad economy. All right, so you see all the values are done this way. I can also double click on this, click on this set simulate assumption. Now by default there's no simulation and no linking, it's just a value that you type in. However, I can click on set simulation assumption, and this is what I get. Now if you happen to be an ROV risk simulator user, you will know exactly what I'm talking about in terms of running Monte Carlo simulations. So we can actually incorporate Monte Carlo simulations, risk-based simulations, on a decision tree, making this a very powerful tool. So to get started, you can choose one out of the three options here. I can set a simulation assumption where we can use that to run a Monte Carlo simulation. Or I can set an assumption and use it in an equation, or use existing variables that I've already created previously and use that in an equation. So let's just use a very simple situation here, like a simulation assumption. We can name it whatever we want. We'll call it 1, whatever. Choose the probability that you're interested in. There are 45 of these probability distributions, the same ones in Risk Simulator. But let's just choose a triangular distribution, which means high, medium, and low. So I may say, this is 10 million, most likely it's 12 million, and the maximum is 13.5 million, whatever you want to do. Placeholders tend to be just a value, whatever you want to put in there. Really doesn't matter what you have in there. In this case, we may just use the most likely. We recommend putting some value in, and typically that's just a most likely or average or mean value. All right. And all you need to do is click OK, and we're done. And you see by default it will be checked, and therefore your simulation will be run. You can always uncheck it if you wanted to. Now that is creating a simulation assumption. You can also create a simulation assumption and use it inside an equation. Now we created that one assumption, so SA stands for set assumption. So we have a set assumption, so we know that it's a Monte Carlo simulation. It's a triangular distribution. The min is 10, most likely is 12, and the maximum is 13.5 as we've done previously. So we can reuse this assumption in an equation. So I can say, for instance, 1.25 times SA1 minus 5.6 for some reason, and I can create this as the equation, and the result of this equation after the simulation will be replaced in this node. All right, so that's for a little bit more advanced type of analytics in this case. But for now, we'll just set an input assumption. You can also set an Excel link if you wanted to. I can click on this Excel icon, and I can select an Excel file. I can select the index, a column, for example. So for example, if your data is, there could be 50 data points in column A, for instance. We'll call this, index in column, we'll say column 1 in this case. So what that does is it will tell you which item for you to execute from that Excel worksheet. All right. So in this case, we'll just keep it as simulate, and we'll set that as an assumption, and we'll simulate this, and we'll click OK. And that's all we have to do in this case. All right, very simple. For the uncertainty node, I can double click on this. So once I've inserted an uncertainty node and I've inserted additional terminal nodes, now in this case there are two uncertainty values, or two events, or two situations, a good economy and a bad economy, and you would see an up and a terminal. I have not renamed this, of course. I've only renamed this as up, so you would see the name up here, and terminal in this case is just a terminal location or address. I can give it a probability, let's say 0.3. Click anywhere else, and it will automatically update a complementary value for me, 0.7. I can also set a simulation assumption on this the same way that you saw previously on a probability. So it's entirely up to you, but just be careful, because you cannot set multiple assumptions on all of these outcomes, because in theory, your probability needs to sum up to 100%. So if you set too many assumptions in here, what we will do is we will common size it to 100%, and we will readjust the probabilities for you, and we will use relative probabilities. So the recommendation is you might want to just set one assumption if there are even 2 or 3 or 4 different events or outcomes. So do not set too many assumptions, if you will. Here, similarly, you can set up nodes. I can say show name value nodes, insert a branch, in this case a branch name, same exact situation that we saw previously. All right. For decision node, same thing here. We can set a name. We can ask it to auto compute, because a decision is where we're trying to decide, at which of these branches is the dominant branch, is the right branch to go with, maximizing returns or minimizing costs or whatever it is, or minimizing schedule risk, all those things. So we can typically by default is auto compute. We can also allow it to custom override, which means we force it to take a specific value. But typically we say auto compute, compute the branch for me. You can put nodes, and the nodes could be above or below. Same situation here, changing colors. And now typically for a decision node, I can add in a label inside the shape. So in this example, I can say perhaps this is an oil and gas situation. I can say drill as a decision, and I can click OK in this case. And notice that the name in here, in this cell is drill. So I can resize this if I wanted to make sure that I can see the words, if you will. All right, simple as that. Now, what you can do at this point is, as we've seen, changing the different styles, backgrounds and so forth, or you can create your own style. Okay, what that means is you can go to shapes and colors. I can change the background color if I wanted to. I can show a grid if I wanted to. So let's just mess around with this just a little bit more. So you can change the colors of that. I can change the connection lines. I can change the decision nodes if I don't like the color of the nodes. If I want to change this to yellow for some reason, and potentially change the font to say size 14, change the color of the font, click OK, and anything else that you're interested in changing. So I can make modifications there. And any changes that you make under shapes and colors will be global in this case. You can apply it to all nodes, simultaneously. You can apply to current and all new nodes, so that the current node that you selected, or apply to the current node only. I can change the shapes for my decision, but typically it's a square. Let's just use the conventional theory of square being a decision node. So we typically recommend doing that. You can change the different minimum size of the height and the width of this box. So in this case, I have a minimum width and maximum height of 32 pixels and a maximum width of 128. So what that means is I can click on this and I can drag this to 128 pixels, but the height is stuck at 32, min and max. Okay, so play around with that a little bit. You can change text and uncertainty nodes, same situation. I can insert a text in this case, so I can select here, type in my notes, whatever notes you want to type in, aligning left, right, changing the colors and so forth, and that's your text. You can change the size of the text to make it a little bit bigger, a little bit smaller, different colors and so forth and so on. So you get the idea, and there you have it. And of course you can change location of the text and all that. You can also insert a picture if you have some pictures that you want to put in there for some reason. So that's the basics of putting together a decision tree. You can zoom in, zoom out, whatever you wish to do. There are different languages that you can go into. There's going to be 10 to 11 foreign languages. For instance, if I go to something like a simplified Chinese, you would see everything in Chinese in here. So my recommendation is go back and keep your default language, whatever your default language is. So in this case, I will keep English as my default. Alright, so that's the basics of putting together a decision tree. Now, let me open up an example file. If I click on File, Example, I can choose any of these decision trees, but let me choose a basic one. Let's say number 2, Market Research, Expected Value, Perfect Information, and Bayes Theorem. That sounds like a very interesting example here. So the decision tree looks like this. In this case, the first decision at this initiation point would be market research. Question is, do I perform market research? So I have two decisions, branches. I do a research, remember this is the branch name, or I do not do a research. Now if I do not do a research, I need to make a decision immediately. Do I build a small, a medium, or a large facility? So this could be manufacturing, this could be R&D, this could be drilling for oil and gas, big drill, small drills, whatever. It really doesn't matter. So let's say this is building real estate. So a small development, medium versus large development. So I have 3 decisions that I'm looking at. For each of these decisions, the economy could be strong or it could be weak, strong or weak with some probabilities. And if the economy is strong, and if my probability is 80% of being strong, and if I build a small facility, for instance, what happens is I will get a payoff of $8 million. Now, however, if I make the right decision and chose a large facility and the economy is strong, I make $20 million. However, if the economy is weak and I spend a lot of money building the large facility, I actually lose money with a negative $9 million. Okay, so that's the basic setup. Conversely, if I decide to do research, then based on the research, market research, assuming that it is credible, if you will, then there are 2 outcomes. It could be a favorable research, the results will come back as favorable, or that the market will be unfavorable. Now, if it's favorable, then you have a decision. I can go, again, build small, medium, or large, and again, the economy could be strong or weak in this case. If it is unfavorable, again, there are 3 levels of decisions: small, medium, or large development. And for each of these, the economy again could be strong or weak. Now, notice that the probabilities have changed in this case because, we're looking at 94% strong versus 6% compared to 35 and 65. And the probabilities here change because we have something called probability updating, or we call that Bayes theorem. So Bayes updating. What that means is if you don't do any market research beforehand, these are your a priori or your objective probability. This is what I think the market will bear. So regardless of what decision I end up doing, it's still an 80-20 in this case. However, if I do market research, and assuming that the market research is credible, and if the market researchers come back and tell me that it is favorable, that the market will probably be favorable, then the probability that the market is indeed favorable after the market research tells it's favorable is a lot higher probability. Rather than 80-20, it goes up to 94 and 6. Now, if the market researchers come back and tell you that the market is probably unfavorable, then you have a higher probability of a weak economy going forward. So the probabilities will be updated in this case, and we're going to be looking at Bayesian analysis in a second. All right. So here is the model. Very, very simple to set up. And I've put it together with a few notes. I can click on run in this case. Now let's run without a simulation, and I click on run, and you would see that this is your optimal path in this case. So assuming, depending on the market research, if market researchers tell you it is favorable, then you should execute a large. If the market researchers tell you it's unfavorable, you should go with medium in this case. That will get you the highest bang for the buck, the highest expected value. And you can actually see what the values will be. $18.26 million compared to $8.15 million in this case. That's the highest value. 7.35, 8.15, and 1.115. In this case, 7.94, 13, and 18.26. So again, when you click run, you can make that decision. Now, if this happens to be not payoff benefits, but let's say it's cost or time, something that's negative, what you can do is highlight the path with the minimum value instead of the maximum value. Okay, so very, very easy to do. You can also run a simulation. I've set up a simulation in this model. So let's just run it at 10,000 times and click on run. And you see at the bottom here it says simulation is running. Please wait. And the simulation is done. So it took about 3 seconds to run 10,000 simulation trials in this case. So whatever assumptions that I have set up, so let's say this was a simulation assumption and this was a normal distribution. So that node actually simulated. So we can click on the summary of values, and you can see the decision nodes, uncertainty, and terminal nodes, and you can see the names and the IDs. The IDs are the locations of each of these, each of these cells, if you will. So we can make a lot of different changes to here. Let's take a look right here and go back to summary of values, and you can see terminal nodes, uncertainty nodes, and decision nodes. So this is just a summary of the inputs and the outputs. We can click on simulation modeling. I ran 10,000 simulation trials. You can look at the mean, the median, all of your 4 moments, your skewness, your kurtosis. I can do a 2-tail, left tail, right tail. Let's just say we do 2 tails, and if I do 5 here, and let's do a 95%. So what that means is this is a 90% confidence. So this is the 5% line, this is the 95% line. So the probability between these two lines would be 90%, 5% on the left, 5% on the right. So the expected value 90% of the time would be have a confidence interval between 14.73 and 17.17 million dollars in this case. Or I can do a left tail versus a right tail, and I can say what is the probability of it being, let's say, at $15 million. Okay, so I can change any of these values if I wanted to. All right, and just override it and type in any type of numbers here. Okay, and you will be able to calculate your values and the probabilities of events. You can copy the charts, you can paste it anywhere you want to, and it should work flawlessly when you are pasting into, like, say, PowerPoint or Microsoft Word. You can also look at input probabilities. Here are all the probabilities as there. Here's your payoff tables. So that's your analysis result as well. We can also go into Bayesian analysis, so Bayesian updating. I would recommend reading through the examples here and clicking on something like load example, and this would be a very basic example that you can get started with. So for instance, you can look at this decision variable. The first uncertainty, we call it A, and we have a second uncertainty. So read through this, figure out the favorable versus unfavorable. This is just a quick getting started guide, so we don't really have time to go into the details of Bayesian updating and Bayesian probability, joint marginal probabilities, posterior updated probabilities. But suffice it to say, everything that you need is right here, and the user manual should be able to get you started in terms of learning what Bayes' theorem actually does. But briefly, what Bayes' theorem does is whenever you have a sequence of uncertainties, in this case, where one is linked to another, in this case, so small compared to this favorable, medium to this favorable, there is some updating, probability updating, compared to we just have small, medium, and large, and there's no probability before it. Okay, so this is called conditional joint probabilities or probability updating. All right, so we can do a Bayes analysis there. We can do EVPI, expected value of perfect information. You can load some examples, go through the details here, read through it. Minimax, max-min, minimizing the maximum regret, risk profiles, and here's just different strategy risk profiles, we can run sensitivity analysis, scenario tables, and do some utility functions as well. So again, this is a very, very quick and dirty example of how to get started with the software tool. Now, to get into the theory, into the discussions of all this, you would have to refer to the user manual for a little bit, or some of our more advanced, modeling videos. So this, again, is just a quick and dirty getting started guide. So you can also click on help, by the way, look at the user manual. Resources that's online. You can click on install license, and when you click on that, you will be given a hardware fingerprint. Hardware fingerprint is pretty much an 8-digit alphanumeric value that is specific to your computer. So every single computer out there has, multiple components, like a hard drive, like a motherboard, BIOS, and so forth. And all of these different elements have their own serial numbers. So we take 5 of these elements, create our own serial calculation, our own algorithms, and we come up with a hardware fingerprint. So all you need to do is email us your hardware fingerprint, and we will generate for you a name and a license key that you can type in, and you will be able to activate the license in this case. So very, very simple to do. You can change the different, if you make changes to the background, decisions, terminal, and so forth, I can click on manage styles, and I can add or save a current style, delete a style, and so you can add style number 11, number 12, number 13, or create your own set of styles if you wanted to. Properties, we've seen that. Global options, you can play around with that. Simulation options to see which path you want to highlight, a number of previous files you want to show on the file link, in this case a list of recent files. You can also protect this file if you wanted to and give it a password with 256-bit encryption, so nobody else will be able to open your file except with the correct password. So that's the basics, if you will. And 2 additional little things here: a tool window and a property window. Property window is, for example, if I select this cell right here with this node, you actually see all the properties and you can make changes to it directly. Rather than having to double click on this and obtain the user interface, you can actually now show the property windows, click on any of these, and be able to enter in any type of inputs like names, branch name, comments, different colors, and so forth. So pretty much what we've seen previously. So that's the high-level basics of looking at decision tree module of ROV Visual Modeler 2012. This is ROV Visual Modeler 2012, and here we're looking at the strategy or strategic options trees, or ST for short. And my recommendation is please take a look at the decision tree getting started tool video, because everything else that you will see here is pretty much replicated from the decision tree piece. So again, you have a starting point, you select on that, and you can insert different options. So in this case, I have 3 different option paths I'm looking at: strategy A, B, and C. In this option, strategy A, I may have a sequential compound option, for instance. So this could be a phase 1, phase 2, and phase 3 with options to exit, walk away in this case. For strategy 3, we may have multiple options in this case: option to expand, option to abandon, or it could be a sequential compound option, whatever it is, different combinations of options. So all I'm doing is I'm making modifications to this tree, adding my tree, moving things around. I can double click on this, change the colors of the tree, add the names, the notes, the values, things that you've seen previously, or give it an option, a type of option. For example, this is an option to abandon. Let's say we'll click abandon on here, and you can see that the name is written inside of that node. So you can resize those nodes as appropriate, move them around, copy, paste, change the styles that you saw previously in the decision tree piece, manage your own style, create your own style, change the colors and shapes on your option nodes, on your terminal nodes, on your text nodes. You can change languages, of course, looking at different properties or global options. You can insert comments, you can link a file. For instance, I can click on this and I can insert either a text or picture. I can add a comment on here, and here's my comment, and you would see this red little thing that pops up. When you point or hover over this red label, it's your comment that you can view. I can click on this and I can insert a file if I wanted to, so I can link to any file that I wish on my computer, and all I need to do is double click on that file icon, and the file will be executed, you would be able to see that. So it's a good repository, if you will, if you have multiple files, different Excel files or Word or PowerPoint files that you want to attach to specific strategies or specific nodes. You can do that as well. Edit, copy, pasting, you can look at data requirements, if you will. So we added an option to abandon. So here are the additional inputs that's required for an option to abandon. So you can put different nodes or different values in here. The strategy tree that we have at this point does not do any computation. If you want to do computations, you would have to either go to the real options SLS, a superlattice solver, and do your mathematical models and put your SLS modules in there. Or if you need to create like a decision tree, you can use the DT module and set up your DT model there and do the computations right there. So strategy tree is nothing but a strategy tree. So we're drawing strategies in this case. You can also do a protect. You can protect the file if you wanted to. But first you have to save this. And now you can put in a password if you wanted to for 256-bit encryption. So anybody without the password would not be able to gain access to this. I can right-click, duplicate the tree, delete the tree. Say if I duplicate the tree, now I have two different trees that's identical. Now I can move this around, delete a specific node or set of nodes, and now I have two different trees. And I can replicate as many trees as I wanted to. I can rename those trees to something a little bit more relevant to myself. And add multiple strategy trees in this case. And when you click on File Save, all of the strategy trees will be saved as a single file. Okay? So everything else is very basic, very easy to use, very user-friendly, and it's identical to decision trees. So hopefully you had a chance to look at this decision tree module video. There are also a bunch of example strategy trees that you can take a look at and see how it's developed. I inserted notes in here. You can insert pictures in here. You can insert anything that you files, anything that you can actually come up with. So here's a build and buy strategy, for instance, and I can zoom in, zoom out. I can do a file print and so forth. So very easy to use, very powerful drawing tool for strategy, and this is part of the ROV Visual Modeler 2012.